Many people ask me the secret to building massive wealth, and I tell them the absolute truth, but nobody wants to believe it. Everyone loves the comforting lie of safety while their hard-earned cash is silently being incinerated by the financial system. Right now, you think you are winning because the major market averages are flirting with spectacular all-time highs. You open your brokerage account and look at the green numbers and feel a warm, fuzzy sense of accomplishment. But literally, as I was getting dressed today, I realized that most everyday investors have absolutely no idea they are holding massive losers right alongside their winners. Every single unexamined asset in your portfolio is like a lazy employee who is actively stealing from your future retirement. We need to sit down and have a serious talk about why half of your portfolio is secretly dying right now. What you do with this information over the next few minutes could literally define the next decade of your wealth. My name is Felix, and I used to work on the institutional trading floors as an economist and a banker. I watched how the big money managers actually play the game, and it is completely different from the textbook trash they sell to the public. Our mission here is very simple, which is to show you exactly what Wall Street is hiding so you can use the same tools as the insiders. The financial media will never tell you the truth because it completely undermines their favorite narrative of mindless passive investing. The standard narrative says that you should just buy the entire market index and sit on your hands for 40 years. Let us look at the actual math because the numbers do not care about your feelings or your traditional assumptions. The Standard & Poor 500 index is up about 9% so far this year, which sounds pretty reasonable on paper. The tech-heavy index is approaching historic highs, and the old Dow Jones average is marching toward 50,000 last quarter. Over 80% of the major corporations beat their profit estimates, which is the highest rate since the free money. Boom. You read the headlines and everything looks fantastic. But this is precisely where retail investors make their biggest catastrophic mistake. You see the beautiful surface water, and you do nothing while the current underneath is moving in a completely different direction. I track 150 different industries across the United States stock market every single week to see where the cash is flowing. Right now, only 55% of those industries are genuinely strong and climbing higher with fresh money pouring into the building. 64 distinct industries are going downhill, which means more sectors are falling apart than are actually rising. Let us bring this down to earth with a real concrete example that you can actually understand. Micron Technology is up 523% from its recent lows, which is an absolute rocket ship. At the exact same time, Nike is down 54% because consumers are completely broke and refusing to buy expensive trainers. Both of those companies live inside the exact same index fund that you own directly or through your retirement account. So if you blindly bought the index fund, you own them both simultaneously. Micron is pulling your portfolio up while Nike is dragging it down into the mud as hard as it possibly can. You have to ask yourself if owning a basket of dying businesses is truly the best use of your capital. This is not a traditional market crash where every single stock drops like a stone at the exact same time. What we are witnessing right now is a massive, violent structural money rotation from one side of the pool to the other. Think of the stock market as a giant swimming pool where the total amount of water stays relatively constant. The main index tells you the pool is full, but it does not tell you that one end is getting deeper while the other end is completely draining. Energy stocks are up 28% this year, making them the best performing sector in the entire country. Healthcare is down 6%, and traditional financials are down 6% within the exact same market environment. Technology has surged 16%, while basic materials have jumped 14%. The institutional money is going somewhere very specific, and if you are not paying attention, you are just along for a dangerous ride. There are three massive macroeconomic drivers behind this hidden structural shift. First of all, inflation is back, and the official consumer price index is sitting around 3.8%. The central bank wants 2% inflation, so we are currently sitting at nearly double their target rate. Energy costs have surged 18%, and traditional gasoline is up 28% at the pump. When inflation stays high, hard assets and real physical commodities win, while paper-based financial illusions lose purchasing power. The second number you have to understand is the National Association of Active Investment Managers Index. This index tracks professional money managers and measures exactly how much of their clients' cash is currently exposed to the stock market. Right now, that number is sitting at 97 out of 100. That means 97% of all professional money managers are completely all in with nowhere left to go. Picture a giant game of musical chairs where 97 people are already sitting down and only 3 empty chairs remain, when every single professional is already fully invested. There is no dry powder left to push broad market prices higher. The specific direction of the money flow matters infinitely more than whether new money enters the building. The third point is that real wages after adjusting for inflation are currently negative across the board. You might be earning more total dollars on your paycheck, but your actual purchasing power is lower than it was last year. American consumers are getting progressively poorer because everyday prices are rising much faster than corporate wages. This acts as a silent destructive tax on the average consumer, which hits consumer-facing retail and advertising industries hard. Let us talk about the specific winners that are benefiting from this structural shift. Starting with physical gold. Gold has always been the ultimate safe haven during periods of systemic currency debasement. Central banks around the world are expected to buy over 1,000 tons of physical gold this year alone. China, India, Turkey, and Saudi Arabia are actively dumping their United States dollars and swapping them for gold bars. The very institutions that print the fiat money are running away from paper cash because they know it loses value by design. Holding pure cash means you are accepting a guaranteed loss because inflation eats your wealth every single day. Gold miners like Newmont are performing even better than the underlying metal because of corporate operating leverage. Newmont is the largest blue-chip gold miner on the planet with a market cap well over $100 billion. When the mining stocks outperform the physical metal, it tells you the smart money is moving in with real size. The second stealth sector I am tracking heavily is uranium, and my primary pick there is Cameco. Uranium prices are up 21% compared to last year because the entire world is rapidly going nuclear. China currently has 60 nuclear reactors running and another 38 under active construction. The United States government just officially classified uranium as a critical national security asset. Massive technology giants are signing long-term contracts for small nuclear reactors to power their artificial intelligence data centers. The massive electricity required for the artificial intelligence boom cannot be satisfied by wind or solar panels. The United States requires 50 million pounds of uranium per year, but only produces 1 million pounds domestically. That is a 98% foreign import dependency on something critical for national security. Cameco is a $50 billion company and the largest pure producer of uranium on the planet. The third critical area is copper, which is rapidly becoming the new oil of the modern digital economy. My specific focus here is Freeport McMoRan because the entire modern infrastructure runs on copper wiring. Copper prices have surged 40% over the past year because green energy requires massive amounts of physical metal. Every single electric vehicle needs 4 times more copper than a traditional gas-powered automobile. Every solar panel, wind turbine, data center, and electrical grid upgrade requires miles of copper. The global market is swinging into a massive 1 million metric ton deficit because demand far outstrips production. There are severe production problems in Indonesia and Chile, while China is actively halting exports of processed materials. Freeport McMoRan is an $80 billion giant that represents the closest thing to a pure copper play on Earth. Southern Copper is another massive alternative sitting at $160 billion, which is exceptionally well positioned. The fourth major winning sector during this massive inflationary cycle is traditional energy. Total Energies is a $160 billion diversified giant that I look at closely. Energy is the #1 performing sector in the entire Standard & Poor 500 this year. While amateur investors argue about whether tech stocks are overvalued, the energy sector has quietly outperformed everything. When you understand where the capital is flowing, you do not have to stress about market bubbles. You simply buy the specific assets where the institutional tide is rising. When commodities enter a long-term supercycle, it triggers a massive secondary boom in infrastructure and defense. The underlying numbers for these unglamorous industries are absolutely shocking to the average retail investor. The non-residential general building contractor industry is up an astonishing 330%. You could have made incredible returns while you were sweating over individual tech stocks if you just knew where to look. Electronic components are up 300%, and heavy engineering construction companies are up 200%. Water and sewer pipeline companies are up 200%. While standard semiconductors are up 170%. These are not speculative meme stocks or highly volatile cryptocurrency instruments. These are real physical businesses that are actively constructing the new industrial backbone of the country. They possess massive backlogs, real government contracts, and real expanding corporate earnings. Every technology giant is spending billions of dollars building out massive physical data centers. Those data centers require high-end chips, power systems, industrial cooling, copper, and physical buildings. Broadcom is a trillion-dollar giant that supplies custom artificial intelligence chips to Microsoft and Amazon. But you also need the physical infrastructure around those chips, which brings us to Comfort Systems. Comfort Systems is an engineering firm that builds the mechanical and electrical systems that data centers require to function. That stock is up 500% from its lows because it provides the essential physical shell for tech. Another massive winner in the data storage infrastructure space is Seagate, which is a $90 billion giant. Celestica is another incredible performer, up 700% because they manufacture the hardware powering the cloud. If you simply hold a broad index fund, forever your exposure to these hyper-growth infrastructure winners is diluted to almost nothing. Then we have the defense sector, where geopolitical spending commitments are expanding toward the stratosphere. Defense corporations possess massive multi-year order backlogs, and government spending is set to drastically accelerate. Rocket Lab is up a stunning 2,700% from its lows, operating in space launch and defense technology. A more conservative blue-chip alternative is RTX, which used to be known as Raytheon. RTX is up 69% and sits firmly on the correct side of the global institutional money rotation. We are also witnessing a multi-decade trend of America bringing manufacturing back to domestic soil. The government is funding massive programs for semiconductor plants, battery facilities, and electric vehicle factories. That is precisely why water pipelines and heavy construction infrastructure stocks are trading at historic highs. Mastech specializes in infrastructure construction, including power lines and pipelines, and is worth serious examination. Quanta Services is another phenomenal engineering firm focused on electric power and energy delivery infrastructure. These companies are completely invisible to the vast majority of retail investors because they never go viral on social media. They do not make flashy front-page headlines, but they are the literal backbone of every single mega trend. This brings us to the specific part of the conversation that should make index fund investors incredibly uncomfortable. Remember that there are 64 major industries right now that are actively losing money. These are not obscure tiny businesses, but household names that represent a huge chunk of your diversified portfolio. If you own a standard market index fund, you are actively suppressing your own returns by subsidizing these losers. Professional services and consulting firms are down 30% because corporations are cutting unnecessary costs. The market is starting to realize that advanced artificial intelligence can do the work of thousands of expensive consultants. Traditional publishing is down 43%, and major information companies like Reuters are down nearly 50%. Global advertising is down 29%, and WPP, the largest advertising agency on Earth, has lost 2/3 of its value. Let us look at this in actual hard dollars, because abstract percentages can make people feel detached from reality. If you put $10,000 into a standard index fund 2 years ago, you might have around $13,000 today. A 30% total gain over 2 years sounds perfectly acceptable to the average casual investor. But if you put that exact same $10,000 exclusively into the climbing industries we discussed, you would have $40,000 or $60,000. And if you concentrated your capital in the losing sectors, your $10,000 would now be worth $3,000. Your traditional broker proudly tells you that the broad market index is up 9% this year, but that 9% return is an average blend of spectacular rocket ships and rapidly sinking corporate ships. The difference between ending up with $3,000 versus $60,000 is completely life-altering. The textbook strategy of buying and holding everything forever puts you squarely in both outcomes simultaneously. The financial industry gives this exact strategy a fancy name and calls it diversification to make you feel safe. Every single unnecessary underperforming asset you hold is a direct drain on your financial independence. Let me tell you a secret that the financial industry will never openly admit to retail clients. Wall Street institutions do not buy and hold assets forever, and they never have in the history of capital markets. Buying and holding is the specific playbook they sell to everyday retail investors to keep them completely passive. It keeps the public sitting perfectly still so the large institutions can liquidity, trade right around them. They collect their recurring management fees from your passive funds while moving the big money into the winning sectors. It is absolutely not your fault that you have been following this outdated strategy, because nobody ever taught you anything different. You have to look at the sheer velocity of modern technological innovation and artificial intelligence disruption. The world is moving faster every single day, which makes holding a static basket of businesses extremely dangerous. Picking one great company and holding it for 50 years worked beautifully for our grandparents, but that world is officially gone. Technology makes it incredibly easy for agile new entrants to completely disrupt and destroy established blue-chip giants. You deserve to understand the actual rules of the game that the insiders are playing by every single day. You do not need to sit through another lost decade watching your hard-earned money move sideways while the smart money triples. The widening gap between the winning structural stocks and the losing legacy stocks is the largest we have ever seen. A blind passive index fund forces you to own both the future and the past at the exact same time. Stop letting traditional dogmatic advice dictate your financial outcome while the world changes right in front of your face. Stay boring with your discipline, stay patient with your capital execution. Peace.